When markets move on geopolitics, most people focus on headlines. Professionals focus on plumbing, the narrow pipes where the real economy flows through. Today's video is about one of those pipes, the Strait of Hormuz. When traffic through a choke point like this slows dramatically, markets don't just get nervous. They reprice inflation risk, interest rate expectations, and equity valuations fast. And I want to do this in a grown-up way. No doom, no political arguments, just a clear explanation of the mechanism and how to think as an investor. In a few minutes, I'll explain why people talk about days in these situations and why a short disruption can create consequences that last weeks. First, let's talk scale. The Strait of Hormuz is one of the most critical energy routes in the world, 20 million barrels per day. That's about a quarter of the world's seaborne oil trade, according to the International Energy Agency for 2025. So when this route is disrupted, you're not talking about a niche logistics problem. You're talking about the pricing of the marginal barrel. Now here's the second reality check. Can't they just reroute it? Well, the answer is only partially. The IEA estimates there's roughly 3.5 to 5.5 million barrels per day of bypass capacity via pipelines through Saudi Arabia and the UAE. That's meaningful, but it's not enough to replace the full flow if disruption is large and persistent. The market immediately adds a risk premium. Let's talk about why days can be a legitimate time unit here. Oil isn't just produced, it has to be stored, blended, and scheduled. It needs to be loaded, insured, shipped, unloaded, and refined. When shipping is disrupted, you don't just lose deliveries, you create backups. If fewer ships are loading, storage fills faster. When it approaches capacity, producers can be forced to cut output because there's nowhere to put the product. And here's the asymmetry. Demand can restart quickly, but supply can't if production was shut in. Shutting down industrial energy systems isn't a light switch. It involves safety protocols, pressure management, and staffing. That's why a disruption in days can generate consequences measured in weeks. So when you hear, "We're a few days away from chaos," treat it as a short way of saying storage and shipping constraints force rapid production decisions. Next, who gets hit first? In practice, Asian importers are first because a large share of Gulf exports is destined for Asia. But even if you live in the US or Europe, you're not insulated because oil is priced in a global market. It's a simple spillover mechanism. When one region scrambles for alternative supply, it bids away barrels that would have gone elsewhere, pushing prices up more broadly. Quick thought experiment. How many days of energy buffer do you personally have right now? Fuel in the car, heating at home. Drop a number in the comments. Now the part many ignore, it's not only oil. In 2024, about 20% of global LNG trade transited Hormuz, primarily from Qatar. Disruption risk can show up not only in oil prices, but also in natural gas and electricity-linked costs leaking into manufacturing and freight. This is the core macro chain. Energy prices rise, input costs rise, inflation expectations go up, and equity markets reprice. Assets whose value depends on future profits, like growth stocks, tend to be more sensitive when rates and inflation expectations rise. So, what do governments do? Toolkit number 1, strategic stock releases. The idea is to smooth short-term shortages and calm expectations. Toolkit number 2, security and logistics. Sometimes the bottleneck isn't oil in the ground. It's ships, insurance, and safe passage. When energy risk rises, people talk about gold. It's less about getting rich and more about reserve diversification and confidence management. Now the practical part, what should an individual investor do? Not panic, not chase headlines, use a disciplined framework. First, separate your portfolio into core and tactical. Core is what you hold through cycles. Tactical is where you allow smaller adjustments. Second, check concentration risk. If one theme dominates your portfolio, your biggest risk isn't Hormuz, it's lack of diversification. Third, replace emotions with rules. Decide in advance what would make you reduce risk. Rules beat adrenaline every time. Fourth, think in scenarios, not one forecast. You don't need to know which scenario wins, you need to be positioned so none of them breaks you. Let's summarize. Hormuz is a major choke point. Disruption can create a day's dynamic through shipping and storage. Energy shocks transmit into inflation and rates. Investors win by using rules and liquidity, not by reacting emotionally. Educational only, not financial advice. Share this with someone who thinks markets only move on headlines, because plumbing moves markets.